Oh, maybe there's a reason after all that gold is at an all-time 52-week high, 23.45. Maybe it's because the Federal Reserve is going bankrupt. In this video, we are going to analyze what the Federal Reserve just said about massive losses at the Federal Reserve. And this is quite the opposite of this sweet, sexy $17,000 set attendees we took over here in the course member live stream trade alert just this morning. In case you didn't see it, we went for 11-cent options in the money, SQQQ calls. So those are calls on the short position at 11 cents, and we were able to dump those at 28 cents for a sexy $17,000 gain on an $11,000 investment. Now, I know right here it says 19,000, but that is because when I filled the order, it got 2-cent worse pricing, but that's okay. Those are still some pretty sick tendies on $11,000 of cost. All sent out to the members in the course member live streams and the Stocks and Psychology of Money group. So, shout out to Christopher, Sergio, Paul, Joshua, this is an interesting name, Lap On, Vanessa, William, yes, Jake, Ryder. Thank you all for joining the Stocks and Psychology of Money group just this morning. Brian, welcome aboard. Jennifer, I see a Jennifer here in as well. This is all access. Nice. Welcome aboard, Jennifer. Great to have you. Okay, so we need to talk about the Federal Reserve, and as much fun as it is to talk trades and that expiring coupon tonight, we got to talk about this right here. The Federal Reserve just released its annual audited financial statements. Now, these are actually audited. There were some rumors that they were unaudited, and an independent firm looks at this. Now, is that independent firm possibly made up of their buddies? Who knows? I mean, it's all probably to some extent rigged, but let's just assume for a moment that this is accurate. Because in these audited financials, they are actually telling us bluntly that their expenses exceeded their earnings by $114 billion in 2023. That is a loss. This is a fancy way to say the Fed lost $114 billion. Oh, yes, our expenses exceeded our earnings by $114 billion. That's a funny way to put it. But anyway, net income in 2022 was $58 billion. Now it's negative $114 million. Billion dollars, rather. So we had a swing of what looks to be over $160 billion. And that is because they're paying out $176 billion on interest expenses. And then, of course, the Fed itself has some expenses as well. They've got over 2,000 members over there. So the question is, and it's KPMG is the auditor, by the way, in case you want to find out who's auditing the Fed. The Fed is audited, though. People do miss that frequently. The Fed does get audited. But I want to explain, what does this actually mean? Like, what are the implications of this? So I'm going to give this a very, very simple explanation. I'm going to try to explain it to us like we're in 9th grade, okay? I'm not going to go with 5 because there's no way in HE double hockey sticks Max is going to care more than 3 words into this. But you should, because you're going to see a lot of FUD and clickbait around this, and I just want to give it to you straight. So, the Fed prints money. Okay, how does that work? All right, ready? Imagine you go into your bank account. You go to your bank, and you're like, it says I have $1,000. And then you go, I need 1,000 more. And you just change the number from a 1 to a 2. Okay, well, in double entry accounting, you have to take that $1,000 from somewhere. So you create the $1,000 out of thin air, but you take it from somewhere. And so in double entry accounting, it would look something like this. You're going to debit, which is an increase. So you're going to give yourself $1,000 of cash, and you are going to increase the other side. So basically, that'd be like a net negative to your net worth, right? So you're balancing it out, hence the word balance sheet. But in order to balance this out, we're going to increase the credit side. And we're going to call this the TMB LOC. Now, this is a very important phrase. Don't worry about it right now. We are going to explain that in a moment. So the Fed's going to take $1,000 because they can, and then they're going to take it out of this credit of $1,000. And cool, now we have $1,000 of cash. So during quantitative easing, also known as QE, what does the Fed do? Well, the Fed goes and buys stuff. So maybe in this case, they're going to say, we're going to use that cash and we're going to buy $1,000 worth of treasury bonds. Cool. Those treasury bonds create a yield, which gives the Federal Reserve net income beyond their expenses, right? And they're going to use cash to buy those bonds. So they created money out of thin air. They used that money they created out of thin air to go buy treasury bonds. That cash from those treasury bonds then can go to the Treasury Department, which then goes to banks, spending, fiscal spending, whatever, the government debt, whatever, right? And so banks can also then take this cash and basically park it back at the Fed, and the Fed will pay them interest on it. So it's kind of like this revolving Ponzi that kind of just goes around and around in a circle. So it's kind of like you got the Fed over here that's like, oh, cool, we just took $1,000 out of nowhere and we created it and we put it into the banking system. And the banking system's like, cool, bro, thanks, man. We don't need this much money. So we're going to put that $1,000 back in over here. And the Federal Reserve is like, cool, we created $1,000. Yay, we're helping stimulate. And the banks are like, cool, bro, so where's my $50 per year because I'm earning 5% on this $1,000? And then the Fed is like, oh, right, okay, yeah, here's your $50. We'll send that over to you. Dang it, we're having to keep printing more money here because our expenses keep going up. And that's how the Fed's expenses can exceed what they're making, is you've got too much money on deposit with the Fed from banks. But that is also then offset by the fact that the Fed is getting rid of their interest-bearing bonds. Remember what they're doing? They're getting rid of bonds. They're selling off bonds. So they're actually reversing this process through what's known as quantitative tightening. So they're saying, you know what? We're going to go back in here. We're going to say, JK, bro, we don't want the $1,000 in bonds anymore. We're going to sell those bonds. That has the effect of making interest rates go up, because bond prices go down, yields go up. This gets a little complicated. But the reversing of this is, okay, man, we're going to sell these bonds, so we're going to get $1,000 cash back, but then we're going to delete that $1,000, and we're going to reverse this process. We're going to delete that $1,000 credit from the TMB LOC, and we're going to delete that $1,000 of cash. That's how they delete money. It's literally the vacuum cleaner. They do this. They vacuum back up money. That's part of the quantitative tightening process. Okay, got it. So this is actually a very normal process. When the Federal Reserve makes more interest than they pay out to banks, so they receive more from the bonds than they pay, they have extra money. They have net income. That extra money gets remitted or given back to the Treasury Department. So the Treasury Department gets the income, okay? When there are more expenses than there is income, who pays? Well, that bill goes to the Treasury Department, which means you, the American taxpayer, pays. So, what's the long-term issue with this? And what the heck is the TMB LOC? Okay, two things. First of all, the true issue is not the plus and minus on the the annual basis. The fact that we were positive 58 last year and negative 158 in 2023, so 22 to 3, that doesn't really matter. That is not the true issue. The true issue at the Federal Reserve has to do with the fact that you still haven't gotten your life insurance, link down below. Go to metkevin.com/life to sign up for life insurance in as little as 5 minutes. It's a paid promotion, but it's what Lauren and I use. You get Apple Pay, Android Pay for it. It's amazing. And if you want to trade, obviously check out the courses on building your wealth, but we also trade through Webull. And if you want to use Webull as well, you can get up to $3,000 by signing up for Webull by going to metkevin.com/Webull. It's also linked down below. So, what is the actual true issue? Well, the true issue is the TMB LOC. What is that? Well, remember how I mentioned over here, the credit side is the TMB LOC? LOC stands for line of credit. So if you go to the bank and you say, hey, I have a home equity line of credit, also known as a HELOC, see, probably heard that before, and you go, I'm going to take $1,000 of cash out of that, the equation actually looks the same. You take $1,000 from your line of credit, you put it into cash. Very, very simple. So what is the TMB line of credit that the Fed has? It's very simple, and I'm pretty sure I wrote it right here. Oh, no, I didn't. It's the Trust Me Bro line of credit, and it's infinite. So it's literally an infinite line of credit, and it is literally the Trust Me Bro line of credit. The TMB, the Trust Me Bro line of credit, is literally based on the world's faith in the dollar, the Fed, and America. It is literally the definition of Trust Me Bro. Because if we did not trust the dollar, which maybe you don't, maybe that's why you buy real estate. That's why I buy real estate. That's why I started a real estate startup called House Hack. Maybe that's why you buy assets like businesses that produce income. Whether that income is denominated in Chinese yuan or Japanese yen or, Mexican pesos, it doesn't really matter, or bananas for that matter, it doesn't really matter. What matters is that you're producing something. So businesses, real estate, these are productive assets. The dollar is really not, and it's one of the reasons why people flock to gold when they get nervous about the Federal Reserve losing money, because when the Fed loses money, there's a risk that you start making people question why they trust the Fed in the first place. Well, most central banks fail. This central bank has only been around for about 110-ish years, and so it's likely that eventually the trust will run out. The line of credit will max. The credit card will be maxed out. The more we run fiscal debts, the more likely it is we run up against that debt clock. But the reality is, America at this point, as effed up as we are, it is still the best of the worst by far for a government-backed fiat currency. Now, in the future, maybe a different government will have a better currency that they use. Maybe Bitcoin will be the future currency and all governments will start using that. Then the Fed's gone. If Bitcoin takes over the Fed, poof, disappears. But between you and me, we have to be real here. I don't really care what the currency is. And I'm not going to make a bet on when the dollar and this Ponzi is going to collapse. At some point it will. But we might not live long enough to see that collapse. So I don't think it's smart to make a bet that the dollar is going to collapse anytime soon, because we don't know if it's going to happen tomorrow, in a year from now, in 10 years from now, in 50 years from now, in 100 years from now. But what we do know is we can get out of fiat by being in assets, like real estate, stocks, maybe even gold, maybe if you're interested in it, crypto assets. Anything that is denominated in fiat can also be denominated in something else, right? I can sell you this coffee mug that's very happy today because I made over $17,000 in tennies. Let's freaking go! Well, it was plus 17,000 minus 1,000. Plus 1,000 minus 1,400. So what is that? That's 18,000 minus 1,400. Okay, it's probably like 16,600 when the day closes. Unless all of a sudden, in the next hour here, something crazy happens and this slight offsetting $1,400 bet I made goes to the moon, which is entirely possible. But I'm not betting on that, so I'm kind of writing that off. But the whole day as a whole was about a 16-4 trade, which is pretty exciting. All the alerts and the screenshots are in the Stocks Insight group. But anyway, what's the point of this? Well, the point of this is to say that this doesn't really matter. You're going to hear about the Fed FUD, and you're going to hear about fiscal deficits, which do matter. It matters that we get our fiscal house in order. San Francisco should declare bankruptcy, and they should get fixed. California needs to fix their spending, and our U.S. government needs to fix its spending. The fact that we're funding things we probably shouldn't be funding and underfunding other things, those are things very well worth debating. So we should be doing that. But does it mean that the Fed Ponzi is going to collapse anytime soon? No. But we need to address the topic and the elephant in the room, which is, it is all rigged, and get into something that at least you have some control over, which I personally think those are assets that you can analyze, like real estate. That's again why I started a startup called House Hack. That's also why we have warrants expiring on Monday and a fundraising deadline of June 30th. And then our mini funds are coming. Hopefully we can IPO that soon. Anyway, thank you so very much for being here. We'll see you in the next one. Good luck. Check out the courses on building your wealth. And goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.